All right, now we're going to take a look at this chapter, efficient markets and behavioral finance. Well, the idea of market efficiency has been around for a long time. It started in the 1970s, and it has been investigated for the past 40 years. So this is something that you should be familiar with. Okay, let's take a look here. First of all, you have to understand the meaning of the random walk theory. Okay, so it says that the movement of stock prices from day to day do not reflect any pattern. Okay, so stock price changes are random. Okay, statistically speaking, the movement of stock prices is random. Skewed positive over the long run. So you should not recognize, you should not see any particular pattern. And that's why we say this is a random walk theory. Now, let's take a look at this. Why do we have to understand this random walk theory? The reason is this. If there were a pattern, if for some reason you could recognize a pattern, for example, you look at this particular stock, right? Microsoft stock price, right? Let's say you could recognize this pattern that the stock price is going up like that, right? Now, as soon as somebody else recognizes the same pattern, right, they try to take advantage of this pattern, stock price pattern. And then when other people recognize the same pattern, then the profit that you could generate from this pattern would disappear, right? Because it becomes public information. So just because you have this information, just because you know this pattern, would not be useful anymore, because it's not something that nobody else knows. So when people try to take advantage of the same anomaly or the same pattern, then it doesn't help you anymore. Okay. This is why we say the market is efficient. All right. The next part is that you have to understand that market efficiency has three different forms, or you could say it comes in three different flavors. The first form is what we call the weak form efficiency. Okay, it says that market prices reflect all historical information. Okay, the key word is historical. Historical information means past information about a company in the past. Okay, so the idea is that anything that has happened to the company in the past must be incorporated into the stock price, right? So any past information has to be included in the stock price already. So just because you know something that happened in the past doesn't help you generate any extra profit, any extra return. Okay, so that's what we call the weak form efficiency. Then the second part is what we call the semi-strong form efficiency. Okay, it says that market prices reflect all publicly available information. Okay, so in the second form, it's not just historical information. It could be current information. Okay, if the current information is publicly available, then it doesn't help you either, because everyone knows what you know, right? The public knows what you know. Okay, it's available to the public. So just because you have a piece of information that is available to the public about a particular company, that doesn't help you in any way. That's what we call the semi-strong form efficiency. And finally, we have the strong form efficiency. Market prices reflect all information, both public and private. Okay, So it says that market prices, stock prices should reflect all information, public and private. So even something that the public doesn't know should be included in the stock price. Okay, now what do you mean by private information? For example, I can give you a realistic example. Let's say you are a scientist working for a pharmaceutical company, right? And you discover a cure for cancer, okay? And nobody else knows about this. The discovery has just been made, so this is private information. You know this information, and nobody else does. Okay. If the market were strongly efficient, then even this information, which is not available to the public, should be included in the stock price, right? But we know that in reality there is some private information that is not reflected in the stock price, and this is why there is a law against insider trading. You cannot take advantage of insider information, because insider information is helpful in predicting stock returns. That's why there is a law against taking advantage of insider information. Okay, so we can say that in reality the market is weakly efficient and semi-strongly efficient, but the market is not strongly efficient. Okay, you should pay particular attention to these three different forms in the textbook.